And we are live. Just chill with me 1 second. I want to see if I can add LinkedIn to this. Hold on, folks. I'm going to try to add LinkedIn to this. Okay, and hopefully I did that. Okay, so we are live. Thank you so much for joining me. We've got a lot to cover today in 20 minutes. So first, if you are new here, I just want to catch you up first, okay? I'm Mitch Goldberg. I'm a financial advisor with 30 years plus experience. I am with the wealth management firm called Client First Strategy. Last couple of days, the last couple of weeks have been nothing like we've ever seen before. We went into a severe, sudden bear market and recession. We've been talking about the market, coronavirus, strategies, what to do. But just to catch you up on this week, on Tuesday, the market had a very big rebound from its, what I consider is the nadir of the bear market. Okay, I said I think we hit a bottom. I could be wrong, and if I am wrong, I am more than happy to change my mind, just so everybody knows that this is what I believe at the moment. But, you know, when the facts change, you have to change your mind. But I do believe we have seen the bottom of this cycle. Because what I've been saying is that if the economy is so weak and in a terrible, very steep recession, just literally the economy grounded to a halt. But with the tremendous amount of, with the open-ended Federal Reserve monetary policy, okay, and with the massive federal stimulus that Congress just approved, that really, I think, removes the nastiest part of the recession that I believe we're in now. Okay, and if that happens, that means investors don't really need to factor in a worst case scenario, which is why stocks were able to rebound. And what I've been talking about is, hey, maybe we have to consider the things that can go right in this bear market. And a number of top people, economists, market soothsayers, but people who I respect and follow have been saying something somewhat similar. But I believe that if you don't factor in the worst case scenario, and if you start to look at the next 6 to 12 months, when we get past this valley and go to the next peak, well, that's what we're investing for. That's why we're investing now, and that's what investors are starting to look at. So we just had a massive rally, another 1,000-point plus day today. Between Tuesday, Wednesday, and Thursday, it's got to be over 4,000-point rally in the Dow. All right, so it's a substantial rally. So I just wanted to catch you up on what we've been talking about in case you haven't been around here for the last couple of days. Today we're talking about dividend investing for the long term, okay? Dividend investing, it's super important. I'll tell you why. It's not the ultimate thing. I don't make my buy or sell decision strictly based on whether or not a security pays a dividend or not. But over the long term, dividends actually account to about 35 to 40% of the Standard & Poor's 500 return over the long term. Now, that percentage is getting a little bit lower as time goes on. There are a number of reasons for that. So pay attention, join me for a couple of minutes, and I'll give you the information to help you decide if you should hop on the Dividend Express. So first, let's hit the intro, and then we're going to get into this. Okay, so we caught you up. We're talking about dividends. You like the background behind me? See that? We're talking about dividends. And A lot of people like dividends. Listen, the ultimate goal is to save your money, invest your money over time. And then one day you're going to want to possibly live off your passive income. And passive income means money you receive from sources other than your primary job. Okay. So dividends and interest, you don't really, you're not really working for those. You're owning, and not to say that you didn't work hard for your money, but you're just owning, you own stocks, you own bonds, and you collect dividends and interest. Um, it's a very nice thing. That's why you save and invest for the long term. So one day when you retire, you have money coming in because, to help replace the income that you gave up from your job, from your career when you're retired. So that's why dividends are so important. They play a pretty big role in the market, and they are often a stabilizing part of the market. So companies make money when they have enough money left over. They pay out a dividend to shareholders, basically as a reward to shareholders to say, hey, thank you. We're going to pay you, $1 a share or 3% annually or something like that. Another thing about dividends is that over time, companies often raise their dividend. Let's say if you buy a bond that pays 3% interest for 10 years, okay, it's 3% a year. So $10,000 pays $300 a year. But that $300 stays steady. It never goes up. Now, if you put $10,000 into a stock and it pays $300 a year, there's a good chance in a couple of years that $300 a year is going to become $320 a year, $350 a year, $380, $400, etc. So companies that raise dividends also help with as a hedge against inflation. So not every stock pays a dividend, but a lot do pay a dividend. And some stocks pay a minuscule dividend, but at least they pay a dividend. And there are certain products, mutual funds, exchange traded funds, that only own stocks if they pay a dividend. So I want to talk to you about where you could get some dividend income, smart ways how you could go about it that still provides diversification for you, which, by the way, diversification is it's a strategy that we use to mitigate risk, but it's it doesn't necessarily protect your portfolio from going down in a down market, okay, such as like the one we're in right now. All right, so there's a couple of things first off to know about dividends. Not all dividends are safe, and I just want to do a quick share screen here. I'll do a quick share screen. Share. And now you'll be able to see what I'm looking at. I'm going to change my screen. Big oil may have to break dividend taboo as debt spirals, investors say. Okay. So, a lot of energy companies are known to pay big dividends. And generally speaking, companies often say their dividend is safe and they'll keep paying it until they have to stop. You don't always get a warning when it happens. It's not necessarily a bad thing when a company cuts its dividend, because a company needs to conserve cash. So instead of paying the shareholders a dividend, they say to the shareholders, we need to conserve cash to protect the company, the survivability of the company. But generally speaking, it's considered a drastic step to cut a dividend. So when a company does cut a dividend, it's not because things are good. It's because we're in a pretty tough time. A lot of companies have cut dividends in the past, especially in the 08-09 Great Recession. But we could see that now. And if you look at how businesses stop, we've just entered into, or we feel we've entered into a recession, and the economy has stopped. A lot of companies are now talking about applying or asking for government bailout money. And a lot of these companies pay a dividend. And, obviously these companies need to conserve cash. So you could see a lot of dividend cuts, which we haven't seen in the last couple of years, or we've seen very little of in the last couple of years. Okay. I know Chevron came out and said that their dividend is not going to be cut, and they're going to do whatever they can to protect it. But that, Chevron is considered the bluest of blue chips in the energy patch, that and ExxonMobil. So it makes sense that they could hold on and maintain their dividend, but a lot of companies are not in the same position. And then I want to talk to you about dividend payout ratio. Okay. The dividend payout ratio is the dividend per share. Okay. You could say retention ratio, but we usually just call that the dividend ratio also. Dividends per share divided by earnings per share. So if you look at a company, and I'll just use a very popular example right now. Okay, let's take a look at AT&T. AT&T has a really big dividend, and a lot of people like AT&T because it has such a big dividend, especially since the stock has gone down in price. AT&T also has a lot of debt. They recently took over Time Warner, and they have a massive debt load as well. So just want to say that the securities that I'm talking about in this presentation, these are not buy recommendations. These are not sell recommendations. This is not personal advice. These are just examples that I want to share with you to help educate you about dividends, so that when you make a decision on purchasing a stock, and a dividend payout is an important part of your reasoning to purchase a stock, you'll know, you'll be better educated in making that decision. Okay. So AT&T's dividend as of now is 6.8%. That sounds really good, but wow, 6.8%. Where do you get that kind of yield? And their dividend is $2.08. But their earnings per share, see $2.08 over here. I'm moving the cursor. I don't know if you can see that. But their earnings are only $1.89. So if their earnings go down, it's going to get harder and harder to pay a dividend that is actually higher than their earnings per share. So if you take the dividend divided by the earnings per share, you get a little bit over 1. But it's almost like the opposite. You don't want that number. And to highlight this, I will first shut off my email, because it's using up a lot of power on my computer right now. Okay. But if you look at a Procter and Gamble as another example, this could take a little while because it's going slow. But if you take a look at that, Procter and Gamble's dividend is lower than its earnings. So they have room to be able to, based on these numbers, to consider their dividend more affordable. Okay. So when I look at a Procter and Gamble, I look at something that is waiting for this to load, that will be more sustainable. And that's the problem you're having. So right now it's really tough to judge corporations' earnings per share because of the shock that companies are going through right now in order to maintain their earnings. Okay, so their dividend is $2.98, and yet the earnings per share is only $1.81. It's not really a dividend ratio that I want to see. I want to see it flip the other way. I want earnings per share to be higher. Okay, so if you look at financial services, you look at companies that have been particularly hard hit, industrial type companies. These are the companies that are going to really take a hit to their earnings. Okay, so that's where I think you could possibly see some cuts. Now, some companies will get through this in 3 to 6 months, 9 months, 12 months will be okay. And a lot of companies will not have to cut the dividend. So when you talk about investing in a stock that pays a dividend, my personal feeling is I don't want a stock just because it pays a dividend. When somebody says, oh, but they pay a great dividend. I remember when GE paid a great dividend, and now it's under $10 a share, and it used to be a top rated, well-respected blue chip. I remember Ford used to be a much higher stock price, General Motors, and they paid big dividends. But what I find is when you see a dividend that is really too big, it's usually too big because the stock price went down. Okay. So if you take the dividend divided by the stock price, that's how you get your dividend yield. So when the stock price goes down, the dividend starts to look more attractive on a percentage yield, but it often could mean that the company is in trouble. We've got a picture of Jim on my screen, okay? But if you take a look at Walmart, all right, their dividend is $2.16, but their earnings per share are $5.19. Now, again, we don't know how the coronavirus economy shutdown will affect that, but it looks like Walmart's been doing okay getting through this market as a provider of a lot of consumer staple type products. So this is what I like to see. The dividend divided by the earnings per share, so 2.16 divided by 5.18 is a lower number, but in the dividend payout ratio, that's what you want to see. So when you look at a stock for the dividend, and I do this with clients all the time. Sometimes I have clients who are retirees, a lot of them, and they say, "Oh, I want some more dividend. I heard about the stock with this terrific dividend yield," and I go over this math with them and why the dividend yield is so big. And oftentimes the client will turn around and say, "You know what? That actually looks like a pretty risky situation." And I say, "Yes, because the dividend is more of a result of the company's financials, and I don't think it's a great way to judge the company's financials unless the company is a dividend aristocrat." So I want to show you a very important chart, okay, that I pulled up here, okay? You see this green? This is the dividend achievers. It's an exchange traded fund. Okay, Vanguard Dividend Growth ETF, and the fund's been around. The ETF has been around for a long time, over 10 years. And if you compare it to the let's say the buyback ETF, I'm using the Spiders buyback ETF, which is the blue down here. You could see, how much better a dividend ETF did over a buyback ETF. If you watched me yesterday and the day before, also I've been railing against stock buybacks. I know people love stock buybacks. They say it's returning cash to shareholders. But from my experience over time, I don't think buybacks have really been good for investors. Companies know that they're going to go into tough times, recessions, that all economies are cyclical, and they're going to need that money. And now you take a look at the airline industry, which bought back something like $35 billion of stock. And now they need a bailout for the government because they don't have enough cash to get through the next maybe couple of weeks. So why did you buy back all that stock and use up all your cash? It's like when you do a big buyback, it's like you're not saving for a rainy day. Let your earnings per share, your fundamentals speak for your stock, and not the buyback, not the financial engineering. Look, buybacks are great because they help the economy accelerate in an up, help stocks accelerate in an up market. But it's like leverage, so they're bad because when the economy slows, the money that these companies had for tough times has been spent in buybacks, and now there's nothing holding it up. And then their true fundamentals come out. You can't cover up bad fundamentals with a buyback. Okay, it doesn't work. Bad fundamentals are bad fundamentals. And what they're doing is the CFOs of these companies are just plowing money to support a stock. I don't think it's really worked well. I'm not against buybacks, and it's a free country. And if companies want to do this, then by all means they should. But as an investor, you and I, we can decide what is important to us. Okay, and if you take a look at the blue, compare this green up here to the blue down here, buybacks, you can see going back since 08, stocks that a portfolio of stocks that regularly not just pay dividends but increase their dividends over time has done quite well. And then if you compare that to, what about a company that just pays a fat dividend yield? Because if you look at the Vanguard high dividend yield index as an example, Again, these are not recommendations. I'm using these as examples, and these are heavily traded, well-known exchange traded funds. It pays 4.74%. So you think, well, that's a pretty good a pretty good yield, okay? But if you look at the VIG, let me just pull this up here. Next time I do something like this, I'm just going to write this stuff down so I don't have to worry about pulling up these quotes. But what I'm going to tell you is it's a good deal lower. Okay, so the dividend on the growth dividend ETF. Just talking to take up the empty space. It's a lot lower. Take it from me. It's going to be a good deal lower. Okay. But I really want to show you because it's eye-opening. Okay, when it comes up. And then if you compare that, we'll compare this to the S&P 500, which right now has a dividend yield maybe about 2% or so. Okay, the dividends have been trending lower. Okay, so the dividend here is 2.5%. The other one was like 4.5%. So the one that was 4.5% sounds better. So you want to go for that, but it's underperformed. So companies that just pay a big dividend, such as a lot of utility type stocks, okay, a lot of consumer staples, if they're just paying a big dividend, but they're not regularly raising the dividend, it's perceived like they don't really have anything to reinvest in. So they're just paying out a dividend as a way to keep you in the price of the stock, as opposed to dividend growers, which in their case, growing the dividend over time has been demonstrative of strong fundamentals, okay, and earnings growth, okay? So let's just take a look who's out there, and I hope this helps you with your understanding of why dividends could play an important role in a investment portfolio and a financial strategy. But you have to really know what kind of dividends you want. So there's numerous ways that you can invest in dividends, and there's tons of mutual funds and exchange traded funds. But my point here is, just because something has the word dividend in the title of its name, it doesn't mean that you should actually think that it's the same as anything else. So we've got a couple of people out here, and I just want to throw a couple of quick hellos out there. Hey, Brad, thank you so much for being out there. Scott, always good to see you. I greatly appreciate that. And we'll just take a quick look at Facebook, and then we'll wrap this up. Because when you come to this little show here, I call it my show, my live stream, Be the Boss of Your Money. This is not just about investing, but it's about, well, investing according to your risk tolerance, your time horizon, your goals, properly investing according to your unique situation. But it's also about personal finance and business. So there's more to it than just talking about the market, why the market was up and things like that. In a couple of years, we're hardly going to be talking about what the stock market went through during the first quarter of the year 2020. That's my guess. And if you didn't believe that, then I have to tell you, there's really and there's no reason to even stay in the market, right? Okay. So I can't see my Facebook right now, which kind of annoys me. But if you know me and you want to text me, you can always send me a text while we're out here as well to let me know you have any questions. Oh, here we go. Okay, never mind. Skip the texting thing. Okay. So got a few people out there. Hey, Jesse, I love you too. Andrew, hey, man. Good to see you out there. Hi, Judy. Hey, Larry, what's up, Goob? Good to see you, man. I'm so glad you checking this out. So that's pretty much my Shakespearean soliloquy about dividends. So dividends are important. You have to check out the dividend ratio. Just basically make sure that a company's earnings per share is greater, to me, I want to see it at least 50% greater than what their dividend is, because once you get lower than that, to me, that's when companies start, or that's when dividends start to become susceptible to a dividend cut. And if you're an investor where dividends are very important to you, and that's a critical reason of why you make your investment purchases, you could be in some trouble with that. That's one thing. Not all dividend products are the same. Just because an exchange traded fund says it pays, high dividend or high yield dividend or something like that, it doesn't mean it's good. It doesn't mean you're going to make any money on the actual security. You could be collecting a nice coupon, but that coupon will probably stay somewhat flat. And then you just have a security that hasn't historically done as well as, let's say, a portfolio of dividend achievers, companies that typically pay and raise a dividend every year for lengths of time, like 20, 25 years. Okay. And then you can use these as part of a diversified portfolio for yourself. So that's my pitch. That's my lesson on dividends. I want to thank you for watching. I hope this helps you out with your investment decisions. If you have any questions and you're watching this in the replay, certainly hit me up in the comments. I will check the comments. I will get back to you, and I'll be here tomorrow for the at the same time, 4:30 every weekday Eastern time. See you soon.